We got some big news for Palantir stock investors as the company reported revenue that were soaring, profits that were soaring, orders are soaring. All of these numbers looked incredibly strong, and I wanted to share with you just precisely how good these numbers were because maybe you've read the headlines about the phenomenal performance of Palantir stock, and I wanted you all to understand what's driving that increase in share price. It's actual fundamental performance improvement from the company and not just hype or enthusiasm. Don't get me wrong, there is a lot of that, but that hype and enthusiasm has a foundational base to it with the company's fundamental performance improving significantly, as I'm going to share with you in this video.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So the company's management team said that second quarter GAAP operating income was $269 million, representing a 27% margin. If you didn't already know, GAAP stands for Generally Accepted Accounting Principles. It's the standardized form that companies must adhere to when they're reporting their operating profitability, revenue, etc. It's a financial statement standard. And a 27% profit margin is really strong for any kind of a company. But for a company like Palantir that's also demonstrating accelerating revenue growth, it makes this operating profit margin that much more exciting because the top line is also improving. Many of the companies that have these kinds of profit margins are not growing their revenue as quickly as Palantir is growing their revenue. And it's more difficult to have this kind of profit margin when your revenues are growing because you're not spending that much time thinking about costs and profitability when your business is booming, right? If some of you are entrepreneurs, you may understand this. When your business is booming, you're thinking about serving that customer demand. You're thinking about fulfilling orders. You're thinking about increasing and keeping quality up and standards high. And you're not really thinking about keeping costs under control, although there is some of that, right? You always need to keep a lid on costs, but you're not spending too much time on that. But when business is slow and when you have this time on your hands where no customers are coming in and you have some extra time, that's when you say, okay, maybe it's time I roll up my sleeves and take out a paper and pencil and bring the calculator, start up a spreadsheet and see where my costs have landed at now that I have some time to think about it, right? And so you'll undergo a cost analysis or you'll look at your cost drivers, etc. And Palantir did that in late 2022. Remember, that's when business slowed down for many companies. That's when the central bank in the United States started increasing interest rates swiftly to try and keep inflation under control. And that created a huge slowdown in economic activity. And many companies, including Palantir, Alphabet, Meta, Microsoft, remember, if you were paying attention back then, this is when companies were announcing layoffs in the tens of thousands, right? And so that's when you do your cost cutting. But Palantir, since then, revenue has been surging, business has been booming, and its operating margin is expanding. And I wouldn't be surprised if Palantir gets a moment to take a breath of fresh air and focus on costs again. It can again create that foundational improvement, and then profit margins can increase even more. So that's just one of the reasons why investors are excited about Palantir stock. In the second quarter, they generated $539 million in cash flow from operations and $569 million in adjusted free cash flow, representing a margin of 54 and 57%. So this is one of the margins I look at closely. It's the cash flow from operations divided by sales, CFO to sales margin. Palantir at over 54% and 57%. Very strong margins in this regard. Very strong margins in this regard. In fact, I could only think of maybe 3 or 4 companies that are at or above this level off the top of my head. And those would be Visa, MasterCard, NVIDIA. Taiwan Semiconductor is around these levels. I don't know if they're as up here ahead, but I know they're up really high as well. So those are the companies off the top of my head that I can think of, and I follow about 200 or 300 companies, and I'm aware of their operating profit margins. And so Palantir's operating profit margin, one of the best of any company, not just in its industry, and it's still accelerating revenue faster than most of those companies I mentioned, other than Nvidia, which is still in its stages where it's generating really strong revenue growth. It's not accelerating, but it's still generating really strong revenue growth. So you have a company with these operating margins and these kinds of cash flow from operations to sales margins, and still increasing revenue and still expanding these margins. And the business model is asset light to begin with, doesn't require a lot of capital expenditure. And you start to understand why this stock is trading at a premium valuation. Well, it's actually trading at a super duper premium valuation. It's trading at a forward price to earnings of over 200, and that's a super super premium valuation. But the point I'm making here is the business performance is excellent. It's excellent, absolutely excellent, top tier. You know, the only knock on Palantir in terms of this kind of performance is that it hasn't been long lived. So some of the companies I mentioned earlier, like Visa, MasterCard, Taiwan Semiconductor, they've been doing this for a longer time. They've been reporting these kinds of performance numbers, at least profitability wise, not revenue wise, these kinds of performance numbers for a longer period of time. So for me, that earns more respect if you've done it for a longer period of time. Whereas Palantir is only in this profit game for a couple of years now. It only turned profitable on the bottom line a couple of years ago, or maybe not even 2 years ago. And it's just accelerating really quickly because the revenue is accelerating, and the business model, like I mentioned, is capital light. So it doesn't need that revenue that it's bringing in. It doesn't need to put it back into the business. It doesn't need to add to the cost base. And so that's allowing for these margins to expand. By the way, this document I'm reading from is the company's latest earnings call with Wall Street analysts. And I have made this document available to my channel members, the highlighted version, the one where I go through the entire thing. This is 21 pages long, and I highlight all the key factors so that if you don't have time to go through the entire thing, you can at least see what I think are the most important things in this document. And I've done this for dozens and dozens of companies, and I keep adding more every week. So my channel members can already see it. You can join my channel for less than $5 a month. See the description for this benefit, as well as many, many other benefits. This is only one of the many benefits you get with a channel membership. Did you know that over 90% of the people that watch my channel are not subscribed? It'll really help support my channel if you hit that subscribe button. And oh, by the way, one of the benefits of being subscribed is that I take requests from subscribers more often than I do from non-subscribers. So if you prefer that benefit, please subscribe to the channel.